I am so proud and so pleased to introduce you to Professor Aloísio Pessoa de Araújo. He has got his PhD in statistics from the University of California. He was an assistant professor at the Department of Economics of the University of Chicago. He has been a visitor professor and teaching graduate courses in the University of Berkeley, Harvard, Princeton, Yale, Sorbonne, Pennsylvania, and Cambridge. And he was elected fellow of the Econometric Society, which is the only Brazilian to hold that title. So I would like to welcome Professor Aloísio Pessoa de Araújo and look forward to your talk.
Thank you very much for the invitation. It's a great pleasure to be here. I'm talking today more about more legal issues. I've been involved in some legal issues the last few years. And the talk that I'm giving today is actually the same talk that I gave 3 weeks ago in the Brazilian Central Bank. I was a keynote speaker there when they talked about the new bank liquidation law. And so my talk will be divided in 2 parts. Okay, the first part will be the bankruptcy law for firms, corporate bankruptcy law. I worked extensively on that, and then I'm going to talk about next to the bank liquidation law that I was involved also in the central bank. I was the only person outside the central bank working the bank liquidation, who had the first public appearance of the law, public consultant, I forgot the name in English. But that was a little before the crisis. So in my opinion, I was very critical of that first version because it didn't incorporate the new ideas that were showing up on the international scene about bank liquidation. And I think Brazil was wise enough to hold up. And now we don't know publicly. I know some idea privately and then being in public by declaration of people in the central bank in the last 3 weeks, some characteristics of the law. So I'm going to comment on this, what appeared in the press. And I already incorporate many of these new issues. So Brazil is being pressured by the FSB, Financial Stability Board, to have a new legislation liquidation. The story in Brazil is long. Let me tell a little bit. Before, there was a bank liquidation that's called extrajudicial. So everything was done by the central bank. And many people were dissatisfied with that, including the past president of them, because there were many legal suits against the directors and presidents and so forth because they were tampering with property rights. And then they want to put everything outside the central bank, or most of it. But with the crisis, the tendency is to put more inside. Although I'm going to mention here, it's a very interesting issue is going on debate in the US. Obama administration put OLA, ordinary liquidation of assets. Important piece of legislation, gives more power to FDIC to liquidate systemically risk banks or firm of institutional of financial institution more broadly. And some legal scholars being criticizing that. We're talking about Jackson and Skill. Both of them have important books in corporate bankruptcy. And they say that you should do more Chapter 11. Chapter 11F, I don't know if you heard about it, Chapter 14. That's a very important debate in the U.S. now. And, but that's, I talked with my lawyer's friend. I brought some of them Americans to Brazil and say, oh, that's too much political agenda now. So I hope the U.S. not become like Brazil, what the politics dominate. But anyhow, it's a very important issue. I think from the side, I like to talk about the important issue before I give my talks. I came liking Chapter 11 against most of the economists, and I'm going to present some evidence. I'm working on it. I'm even an American economist. And that's the way you did it in Brazil, adaptation chapter for corporate bankruptcy. But, and so I like this idea to go to judiciary. I think in the case of banks, the main argument is that the regulator is faster and knows more about it. But the judiciary is more secure, cannot sue the judiciary. So they have more courage to take a decision. So how to go in between the two? Between the two, I think that's the main issue. It's a deep issue. No economists have the answer. No lawyer. So, but we should capture a little bit of that, mainly after the crisis, where the needs for new regulation is more important than ever. So, but there on the positive side, there are some new ideas that, and the Brazilian Central Bank already announced has incorporated some new ideas. And then I am very happy, although I don't know what's exact measure of those new ideas. I'm going to talk about. I like to say everything before I start. So the main idea is that to bail in, living wills, haircuts, loss of shareholder value. Anyhow, I think that's the main issue that should be incorporated. But how much of it is not clear. But anyway, many in this meeting in Central Bank 2 or 3 weeks ago, where it was a keynote speech, was very interesting, because there was some people speaking about the new legislation in Europe, no? The FDIC, there was the one of the main person in FDIC, talking about the FDIC is doing about it after the crisis and so forth. So it's a very hot topic, so I hope you enjoy it. But first, I want to be perhaps a little bit in a different mood than my colleague here has talked so badly about Brazil. but it depends if you want to look the glass half empty or half full, right? So I like to see it's half full, more and more. I don't agree with him. There's so much to be done. But I'm positive about this corporate bankruptcy. And if you can get into line with the world in the bank regulation, so behind even before the crisis, that would be another big advancement. So let me talk about bankruptcy law. Oh, God. Oh, yeah. So I'm going to talk bankruptcy law reform in Brazil and Wisconsin. Now I already published in the paper. Good, right? Because before I was just a consultant. Now I'm writing a paper in Journal of Corporate Finance and many other journals about the Brazilian bankruptcy experiment that's becoming well known internationally among academics. Some other people work on it. Then how bad is Chapter 11? That might sound a little strange for Silani is not here. I didn't prepare that for him, but if he were here, I'm sure he would not like that. But that's the way it is. I don't think Chapter 11 is not that bad. I will be giving a course in Harvard next quarter, so I have a chance to talk with Schleifer also. but anyhow, this is a... and then I talk about bankruptcy law for banks, okay? So let's talk about the bankruptcy law reform in Brazil. First of all, let me criticize the data that I'm going to show you, okay? That's doing business, okay? And then I was reading the newspaper. I never liked doing business too much. And then I was reading the newspaper this morning while he come in the plane here. The issue of the economists just appear, and they are considering dumping the whole idea of doing business. No, the current main person in the World Bank. I hope they don't. Economists saying that they should not do it. They should not do pressure from JHA. I think they are very. In case of Brazil, I think they are very unfair. I don't think Brazil is as bad as they say. But Brazil is pretty bad, and I think that's put pressure for law for reform. That's the main line of defense of the economists, and I agree with that. And also, if you look at this, the way their methodology, and look across time, you see that Brazil improved a lot. So I hope they are not totally wrong. I don't want to put to base all the scientific claim on their data. Okay. So this is Brazil recovery rate. Brazil is 0.2 cents in $100, something like that. This is essentially zero, okay, before the law. That's the doing business data. Even Latin American countries do much better. That's in a paper of mine, all this data, previous paper in some journal, Latin America, La Ceia journal. Was published before the reform in Brazil. And here is the recovery rate, Brazil compared with the other Latin American countries. Again, I think that's exaggerated, okay, but anyhow, some of it is true. That's the doing business data. The average length of insolvency procedures in Brazil, 10 years. Latin American countries, between 3 and 4 years. What did the change here in Brazil? I was quite involved with several years of my life, 8 years, the consultant, and I went to the Senate. And so. Security credit started actually this reform in Cardoso time, and then it was approved in Lula's time. But Arminio Fraga was the main initiator of this group in the Central Bank, extremely interested, lawyers, economists, and so forth. So what we managed to change, security credit now giving priority over tax credit. Because in Brazil, there's a very, was bad economic, not bad economic, need good economic to understand it, but was bad economic incentive because Brazil had lots of indirect tax. If a firm had problem, it stopped paying those tax. It's easier to withhold this tax. And the tax debt increased very fast. So the banks knew if they're going to be liquidated, the tax will come first. So they stopped. So credit was extremely unstable in Brazil. It was very, very small and unstable. Because tax credit would come first under liquidation. So to change that was extremely hard. It took our last effort in the Senate to do it, but I think that was very important. Labor claims now limit to 150 times the minimum wage. Before, any executive of the firm could claim employ his wife or his brother or somebody, and then that will come first. There was no up limit. Lots of abuses. Now is this limit, even the unions agree in the end that should be done. The insolvent firm can now be sold as a whole. That's important for bank also. If you sell it as a whole, then you discuss who the creditors are. Before you have to make the rules of tax creditor, or not tax, or the creditors. So that would take forever, and then would rot on the firms. Now you can sell the firm first, or whatever part of the firm, and then put in an account, and then discuss who has the claim of it, the right claim. Now we have the stay period, automatic stay. Economists don't like that. That's my provocation against the economy. I changed side. I start with all the discuss of the economists, then I change side, become the lawyer. So I'm not talking, I talk about the economists like the same way I'm talking here, okay? Because chapter 11, oh, this do that, rise, that, but it's smarter than that. So we have a automatic stay, and only creditor holding claims higher than 40 minimum wage can start a bankruptcy procedure. Before the bankruptcy law was used as a tax, as a credit collection device. So there are too many. The judiciary was full of cases that were not really bankruptcy cases. And now tax, labor, and other liability are no longer transferred to the buyers of assets. That was huge improvement. If you buy a piece before, if you would buy a piece of a firm, you'd inherit all the liability, hidden liability. So you didn't know how big they were, the tax and the labor. Now we sell it without any. A new tax, now any new tax, data in possession, this idea. 7 is data in possession, okay? So we introduce data in possession. It's very important. Now credit now play more important role in the reorganization, different from concordata. Concordata was just divide the credit in pieces and that would be it. Now, the credit play very important role in the creditors committee. So we enhance the power of the creditor. They have to approve. We still have, there's some little problems. We still have calm down. We introduce a little form, a simplified form of calm down. There's sometimes case problem, but essentially creditors do have some say, very important. While before I didn't have any say. And we introduced a prepackaged provision. It was very hard to pass also in the Senate, but we worked hard on it and then stopped approving the law for some months. But it was worthwhile, I think, because now we're giving incentive for firm to renegotiate before the case go to court. This number 8 now is very important because from what the central bank said, right, it's not public, the document there, is that they're going to introduce some mechanism of, I think will be very wise, in the credit committee inside the central bank to approve the reorganization. So I think we'll be more protected legally. So what's the data? If you start down, you see the recovery rate went up very fast. Then it came to a stop. Now it should go up more. I think, again, I don't think that doing business do a reasonable fare to Brazil. But anyhow, it went up very fast and then come to a stop. Is still very low. Look at the number of liquidation, of bankruptcy case. It came down a lot because now it cannot be used as a collection device anymore. So it doesn't fuel the judiciary. Judiciary has lots of problems in Brazil. By the way, they accept the law pretty reasonably in Brazil. It was a surprise. It was a nice surprise about it. I was talking, giving lots of lectures to judiciary and say, oh, is that going to hold or not? And then it was very nice. They accepted. Essentially, you can always complain. If you talk to lawyers that defend banks, say, no, they talk to a lawyer. They're all my friends before, but now they have different views. Talk with the work for firm and say, no, but it's huge, much better than expected. But, and then, look at this nice data here. Private credit fund to GDP ratio. That happened in Brazil, okay? It's not only the BNDES that gives credit to firms nowadays. Look at that. That's only the sector is not credit for individuals. That's credit for firms. And the middle market firm mostly, because the big firms already had it. My friends that do econometrics, they believe more in this in the graph than me, but they still my ex-students. So they know more and they believe more, but I still believe some of it. You see the huge sharp due to the law. And you publish some paper. Is more different, sort of econometrics, simple econometrics, but now we're working harder and more deeper microeconometrics. my students know this stuff, so I'm more a theoretician, but they know they're doing more of that and more micro econometrics. This is just different diff. Here, the last year comes to a flat because that was the time they cried. Then increase a little more. Now it's coming to another flat. So the tendency, I think, is still to increase. There's room for. So that's a changing law, and it can occur in a poor and developed country. Economists talk a lot about institution. Law talk about you have to do concrete case of institutional change. Unfortunately, it doesn't happen that often. Look what happened, compare with the credit to GDP. Some friends from IDB, the main economists, they say, oh, Luis, but that's all Latin American improve. Then they use a control group. The other countries in Latin America improve a little bit after that. But look at the difference in Brazil. They use the control group, the other Latin American countries. They were improving a little bit the credit. But look at Brazil. It was definitely, there was an effect of the law there, found in a more scientific way. Other concept of the bankruptcy reform, average time to resolve insolvency dropped from 10 to 4 years. Do you remember that 10 years in Brazil, 10 years to insolvency procedure? Now it's 4. Again, according to doing business, the staff in Brazil, I don't know why. Because the law firms in Brazil, they respond to that attack in Brazil. Sure. Because the country is more developed, they want better institutions. They're more upset at it. That's my view of why. But anyhow, the same people that judging it, they drop from 10 to 4. It's huge. We want to go to 1, 2. It should to be more ambitious. Brazil should be to have a better institutional environment. Increasing the total debt, we also found that in the microdata. We work with a lot of microdata, not only the central bank data, the aggregate data. Decreasing the cost of debt, decreasing the cost of people look, oh, the spread didn't decrease in Brazil, but they forgot that the spread, the average spread, the central bank published, but the spread for small firm, the small firm now has more access to credit. So the average quality of credit worsened, and you capture that some study. So given the size of the firm, the cost of that decreased. So the spread decreased. The big spread in Brazil for other reasons also, tax and so forth, but increasing the average maturity of credit become much longer. More credit to riskier firms, so smaller firms and so forth. We did other financial reform also. Consumer credit was very important, payroll credit, and can be easily taken from bad debtors. Mortgage, new type, I think is extremely important, but those were more obvious. That was so crazy. Mainly the mortgage. Brazil didn't have a mortgage system. It's so stupid. That they just needed this much smaller change. Even more important in my view, but bankruptcy law is very complex. Deals with the judiciary, law firms, banks, academic people, congressmen. It's much more complex. Just change that, and then it's increasing now. I think that was another thing the positive side. Unfortunately, that was already 8 years ago, but very little has been done since then in other direction. The banks, I hope, is going to be done. But why introduce Chapter 11? In Brazil, introduced Chapter 11 also for political reason. I want to confess, I mean, I changed sides intellectually, but also it would not pass in Congress because Congress wants to save firm. And what's the advantage of Chapter 11? You save firm in a more systematic and more organized way. It would be very difficult to pass without this. And credit reform that too pro-credit, like economists wanted, didn't have a good success in Latin America. Mexico judiciary rejected the law. There was a law that's very pro-firm. Not pro-firm, sorry, pro-creditor. But then the judiciary said, no, this law doesn't exist for us because this law is against Constitution. I didn't accept it. So they had a new law. Now the judiciary has all the same. Extremely bureaucratic. What I heard that they didn't have one single case of reorganization. So that's why I like the U.S. system. Give reorganization, but in a more organized where the creditor says some. So it's very interesting. Argentina also has a very pro-creditor, the economists liking. But when the crisis came, then the Congress said, oh, come on, you're passing all this firm automatic to banks? No way. And they changed the law in the middle of the crisis. So that's the worst. They have a law that cannot hold difficult times. So it's better to be in between. That's one of the reasons. I think there are some other reasons. So Congress and Judiciary think their residual property right of owner of the firm in case of distress. You cannot just wipe out and give to the creditor. There's some debtor rights also, very subtle way. Options, values of firms, and so forth. And I think that's what the U.S. legislature understood it, while Europeans still don't. And Brazil is the only case in Latin America that did it. We did for the political pressure, otherwise they would pass the law, defend all the firms. So people were discussing like, oh, we cannot have any big firm in Brazil closed any longer. That's an absurd. It would be a completely crazy legislation would pass if it didn't offer this Chapter 11 possibility. So how bad is Chapter 11? So there's an intellectual digression, okay? There's a little model here. The Chapter 11 depends on the structure of the productive sector. Essentially, the idea is saying, and cost of liquidation. It's two main variables. Should one introduce Chapter 11 or not? Put that as an intellectual question. If the country has a lot of tangible capital, a loss of physical capital, you should have just liquidation because you liquidate firms and that's it. But if the firm have lots of intangible capital, like the U.S., and you look at the NBR data for the productive sector, and then you should be more for organization because you want to incentivize the non-collateral based or non-guaranteed loans. So another way of putting it, should give the firm a second chance or not? You should not give due to moral hazard. Economists like moral hazard. But you should give if there is a bad state of nature. Because there is a bad state of nature, then the firm perhaps not that bad, was just hit by shock. Then you should have a second chance. So to compare these two depends how much physical capital the firm has compared to intangible capital. Another important way, another important variable, is how much is the cost of liquidation against the cost of reorganization. People, economists say, oh, just liquidate. But then the judiciary is very bad to liquidate. Even now, one of the main criticisms, I've been talking with my friends, top lawyers in Brazil. Just after the bank, I talked with them, and then they pointed to me again, that's the main thing now with the new law. The new law is not a paradise, far from it. Is that the fact that you cannot liquidate easily because nobody wants to be an administrator under liquidation because he'll be personally sued for it. So liquidation is a mess. Since the beginning, for my surprise, even banks were favor Chapter 11 in Brazil because to liquidate firms is a mess in Brazil, and it continues to be in great extent. Although introduce the governance of liquidation change because now you put the banks first, so they have more power to liquidate firm. They put the lawyers to work. Before they would not get anything why to bother about it. And then the but another. And then you can send as a whole concern, as the firm as a whole, and then send it first before decide who the creditors are and so forth. But now we miss this. The person that's in charge of the organization procedure, the private person, the private firm, can be sued. And it's a disaster. Okay? So he doesn't want to take care of it. So there are too few liquidation. And since we don't have the threat of liquidation, the value of Chapter 11 diminished. So I don't want to put as a lots of room for improvement. Anyhow, this is I say that the cost of liquidation is very high in Brazil against the cost of reorganization. So this relative cost. And one interesting thing in the U.S. that was a paper published in the Journal of Finance after you start doing this, saying that my friends lawyers in the U.S. I had some legal lawyers, a friend of mine. They've been telling me, oh, these people don't know what they're talking about because the cost of reorganization in the West came down a lot. The economists were too much against it because there are few cases, extremely high cost of organization. But saying the banks learn how to do it, my friend told me. And then appeared this paper that confirmed it. So I found it very interesting. So, and in Brazil, the cost of liquidation is extremely high. So anyhow, this is a little technical. I don't want to go over it, but I'm saying that this graph here, which country should have Chapter 11? Countries that have a lot of share of physical capital should have Chapter 7. Countries that have lots of big share of physical capital, Chapter 7. So you just liquidated, that's it. Sweden, something like that. Not the U.S. U.S. has lots of intangible. You don't associate the U.S. as somebody has lots of capital in the U.S., but it's not true. Not physical capital. There are lots of intangible in the U.S. And also the cost of liquidation against the cost of reorganization. The cost of depreciation liquidation is very big, then you should have Chapter 11. That was the case in Brazil. Even the bank was saying, no, Chapter 11 is not that bad for us. So it's interesting. Even banks are saying that because they're afraid of liquidation. And it's still bad, the liquidation. So it's against economics intuition. So we did all this study. You see, what we did there, there's some deeper issue. I like academics, okay? Sorry about talking about this economist way of looking at things. But which law should you design for which type of country? Okay? That's simply the question I try to answer. It depends on the country. Oh, there's the work of Laporta, Silanes, and it's a pity he's not here, so we can criticize him more freely. Sorry about it. I have big respect to. I think he's a great scholar. I like his life a lot. But there is this case. I mean, should we follow the idea? They had this. I think that the work is very innovative. Okay, the law and finance. I love this work. Okay, but I think do a little more refinement now. But they didn't have data, so they put 4 indicators all lumped together. They add those. 1, there is no automatic stay. 2, manager remove in the case of organization. 3, reorganization prestige not restricted. Secured credit come first in case of liquidation. The last one is obvious they can, okay? It's true, obviously sure. The other one is not clear because there is no automatic stay. If you have automatic stay, you have a more coordination device. It's true, it's bad against more harder from the part of people that take too much risk. But then at the same time, you protect firms in case of bad state of nature. So what's more important, more hard or bad state of nature? So, and then, and also, what they always study now, we look at the value of the firm. It's not only the amount of credit, because now I have more data at the firm level. So you can look at the stock market value of firm. According to corporate finance, that's what you should do, right? Not only the amount of credit. You don't want to maximize the amount of credit. You want to maximize the value of firms. And now we have the data to do it. So we did study from each of these cases. Marriage should be removed, but then the marriage should be removed in case of organization, it's good to remove manager because they have more hazard. But at the same time, it's bad to have a removal of manager because manager are they know more about the firm. So we study each item of those separately because they have more bigger data set. So we came more mixed conclusions. So that's I'm not going over all of this because of, but I just make a summary, okay? It's more mixed result, okay? It's not that clear that you should just have none of those. The last one, secured credit come first for sure. The other one is some of them are good for firms, bad for creditors, and some of them are a mixed result. So it's, but anyhow, we should now have more data, okay? Their work was pioneer, so they lumped together. I think to do single is more. Now about banks, okay? That's a big question. In Brazil, we benefit because there was a system in the US, Chapter 11, that could more or less copy and adapt it. But how about banks? Banks don't have a good framework to adapt and copy. People, many countries abroad following new guidelines. No? There are the Financial Stability Board gave some guidelines and then so forth. They're trying to adjust it. So banks, for economists, you cannot have a fixed bank. It's impossible to fix bank because banks essentially, if they're any good, they should cause problem. Because banks should provide liquidity. So you should provide liquidity, they should not be matched completely the asset and liability. You should not do that. There's a freedom of bank. I want to match them asset and liability, and then to match completely is no good because you don't create value. But Hayek Bank also is perhaps no good either. That's self-regulation. So how should do it is a big question. There's no simple. I'm sorry. So why banks are different? Systemic risk, they provide liquidity, but they have coordination problem, okay? Bank runs. So we're showing some data from the World Bank, okay? Is there a special insolvency work? Banks are different, no? Economists know that, and most countries now have special insolvency. From 2008 and 2012, it's a big change. Now they have special provision for most big economies already had, but now all of this is a huge sample from the World Bank. Bank fragility, Diamond Divic, deposit insurance against in the Socratic shock. You should have that. That's something that you learn already from the practical point of view since the Great Depression. FDIC was a product of that. And then deposit insurance, provides an issue against bank run, an instrument against bank run. But if you put too much incentive, too big deposit insurance, you're going to create more hazard from nobody's going to watch the situation of the bank. And then you're going to have much more lax banks. So there's no good. So you have a limit on that. So what's this limit? But anyhow, we should have deposit insurance. What happened in the world? Brazil created deposit insurance in the 90s, in the midst of a bank crisis in the 90s. The late 90s, it created deposit insurance. Nowadays, most countries have. That's a very recent phenomenon. Only half and half had before the crisis. Now most countries have it. Against developed countries have it. More hard, the bank owners and government is a feast for economists, okay, of asymmetric information economists, because it's a feast of all asymmetric information all over, between bank owners and government, between bank credit and government, between CEO, managers, and shareholders, okay, all over. So how to balance between that? But the answer is not just being tough on moral hazard, because there's other side of it. Perhaps you create a different moral hazard. Moral hazard owners versus bank. In the absence of institutional framework, central banks usually prefer bailouts. Goodhart and Shoemaker, out of 104 failing banks, 73 were rescued. That was before the crisis. At the time we didn't have big banking crisis, but the authorities already panicked in case of afraid of banking crisis. So helping banks was the rule. Is that of Goodhart and Shoemaker's interest. Large banks are too big to fail. Moral hazard leads to riskier behavior. Possible solution: debt to equity conversion, capital dilution. There's bailing-in. Bailing-in is becoming the rule after the crisis. All the councils talk about bailing-in, the FSB talk about bailing-in, the European proposal talk about Brazil. Central Bank announced they're going to make a bailing-in procedure. Although shareholders should lose the entire capital, I'm not sure should lose the entire capital, because that creates more hazard, because the shareholder will gamble the bank even more, since it can hide the situation of the bank. So to have a little bit part of the shareholder might be good, but very small. They cannot become still rich after the banking crisis episode. Come last in priority order, the shareholder. Restricts operation of large bank. That idea that appear in the U.S. a lot, restricted, but it's not come to force yet. No country is still doing this instrument yet. But say, is there more hazard credit? Bank credit against the government. One very important source of moral hazard is when bank creditor lend to the bank in the difficult situation, because it's going to be rescued anyhow. Finance bad banks. And that's a possible solution: increase haircut, cocoa bonds. And Hart and Zingala has a proposal: automatic conversion of debt into equity, creating stability, raise the cost of capital of banks. So these instruments are nice, but they might increase the cost of capital of banks. So you should use it with prudence. Forced equity conversion. Now, which authority has the power to subsidy shareholders' right? Before, the court had lots of important share. The court share now decreased a lot. And the central bank increased. What we've seen after the crisis is increasing in the role of the regulator. Obama, for example, increased the role of FDIC with OLA, although some legal lawyers in the U.S. against it. So it's not clear that, for me, tell you the truth, I don't know exactly. But that's the way it's going. At least I believe now should be more, it should be a strong hand of the central bank. But has a moral hazard. One bad thing about central bank I didn't mention, intervention, is that the moral hazard of the regulator. And nobody talks too much about it. I think that's very important. In the U.S., for example, how come all this, I knew from Brazil, you don't know that, but I knew that the crisis was coming. If I knew it, many people knew it. How come the Fed didn't act before? And I think because the Fed acts too early, and then tell a bank, you have to capitalize, sell your bank for a very low price. And then, due to the action, the crisis doesn't come. What's going to happen? The lawyers of the bank say, no, come on, you're academic, come here, tell my bank should be sold. No crisis come, you take good care of banks. And so the poor guy, the central bank or academic, there's the director of the Fed, or the president of the Fed. I think the moral heart of the regulator is very, if you put that in the hand of judiciary, nobody's going to argue with the judge, So people say, they tell me it's true. The regulator, FDIC, I talked to the main woman, the FDIC 3 weeks ago, Mary Azevedo, I don't know, and then she told me, no, and everybody tells that. The US, you cannot have problems with the FDIC because they're well protected under law. In Brazil, no, you sue the people in the central bank very often. And then, but still, I mean, underlying your professional career and so forth, it's not clear that you should. But anyhow, it's going the direction of federal, or the central bank is having more power, not in the direction of judiciary. CEO versus bank owners, and then high bonus increases expected value of the share of the CEO, and then takes too much risk, give golden parachute, unlimited gain, limited losses. But you still want to preserve some incentive for CEOs. You don't want to raise all of them. But in Brazil, for example, there's now an interesting clause that the public traded firm should announce how much derivatives they have, what's some salary of CEO and so forth. There's a legal debate in Brazil how much they should be exposed, but anyhow. Which authority has the power to remove and replace bank senior manager? Most cases is the central bank. Okay, the court is shrunk a lot now in 2012. So it is the direction. But Chapter 11 for banks, that's my end of my talk, the last issue. The role of judiciary versus the role of regulator. No? Banks regulate are more proficient. They know more. They are faster. But they are afraid of lawsuit leading to more hazard. So they have more hazard from the part. I think you have to take lots of courage to get to big banks. You know, and then the cry doesn't come because you act, and then you even look more fool. But judiciary, no legal sue, but slower, much slower, and no proficiency. So to put all this in the hand of judiciary, these people. So the two proposed in the U.S., I think, is a paradigm usually for this new regulation. The front runner on this, you should look at them. There's FSB also has some interesting ideas, but Obama went to more power to the FDIC. Some people say it's too bureaucratic, it's not going to work, and so other people come. Chapter 11F, Jackson, Skew also, David Skew. They both are important books in corporate bankruptcy, and they say you should stand it. Very appealing, some of the arguments. I found it intriguing. FDIC, SEC, and other agencies should have the authority to according to them, to file for bankruptcy, not only the central bank, but the FDIC and so forth, and then go in front of the judge, and then data in possession from the government money comes in to save banks, but then will be data in possession. Will be in the format of the Chapter 11 for firm that worked so well. So it's very intriguing. I liked it a lot. But I don't say that I should introduce them because that's a different issue. I like as a thinker, but as a regulator, I don't know if I'm ready to say that. People that usually, I think, take a more pessimist view about putting this in practice. So they want to put some derivatives, not all of them, some derivatives, Chapter 11 on automatic stay, not all of them. Non-cash repos will be included, and so forth. Okay, that's most countries now have introduced change, and the more is going to introduce. There's a data of the World Bank again. Okay, and then thank you.
Okay, thank you. We have short time for questions. I'm going to start with the first one. Professor Aloisio, you have a very extremely interesting data from a major legal institutional change in Brazil, the Bankruptcy Reform, and its consequences to the development of credit markets. So in a sense, your data and your presentation supports the broad Laporta, Lopes Estilantes, and Schleifer claim that if you have more creditor rights, you're going to experiment more developed credit markets. So there is a correlation of rights and development of markets. But you don't really agree, as you said, with the measures, how the specific rules that they measure legal protection, right, for creditors. Also, from their work, they try to disaggregate the role of law, legal rules in the books, and the role of enforcement. And that's my question about, because at the same time we had this bankruptcy reform, we had the specific varas created for bankruptcy law, first at Rio de Janeiro. So my question... Yeah, so... But
São Paulo was created.
The São Paulo was created, that's right. But then I was wondering whether you had more the explanatory power of the variables, whether they are, in your opinion, I mean, is either only the law or is more reliance on judicial activity? Because you mentioned in your talk that the years of legal procedure has dropped from 10 years to 4 years, and how that would play out. My concern, I'm asking this question because I'm a corporate lawyer, and I'm concerned with corporate law. We have enormous rights for minority shareholders in the law, but then we don't have a way of making them enforceable. So just trying to access what's your opinion between law and enforcement.
Okay. Thank you. No, two very, very good questions. First of all, I mean, it's very hard to talk about the first issue, okay, because I don't want to be misread, saying, oh, you don't have to have creditor right. First of all, in Latin America, in Brazil particularly, Pepe should have said that, since the other one, second argument for more intriguing, more new, I tend to talk more about the second issue. But the basic issue should have more creditor right, okay, that's for sure. And in Latin America, in development countries, I think Schleif is completely right, because there's very little creditor right, okay, first of all. The bad mistake, I have the graph saying that, well, I'm not going to go over my graph. I used it a lot while I was working the bankruptcy law, saying that to give too much credit right is bad for credit, because then the debtor is never going to get loan. And if you get too much firm right, the credit is never going to. And then in this graph, there's an optimal protection. And in this Brazil, most poor countries fail much more having too little legal rights for creditors, okay? So that's the main mistake. So let me make that clear. So the rest is a little more academic, but it's important. But how to get the creditor right? For example, we introduced in the law in Brazil, the U.S. has a adaptation to the U.S. The creditors committee. And they have to approve, according to different class, the plan for the firm. So that's enormous power in the hands of the creditor. I mentioned that, but Pesha mentioned I spend more time talking about that. So that's the part of new law. The creditors secured credit come first on the liquidation. So there are lots of important instruments that enforce the creditor right. So what I'm saying is that is the Chapter 11 good or not? That's a different issue. So U.S., I think, has lots of creditor right, extremely powerful, but their measure is not completely. And then they, for example, give a bad grade to the U.S. because the U.S. has Chapter 11. So I don't think that's and England has have a higher grade because England just have liquidation. So it's a more subtle issue. I believe in creditors' right. In Brazil, should introduce even more. But to do a reorganization of firms, I think is good. My general feeling, okay? Although it's not, the data comes much more mixed, okay? It depends on, mainly if you disaggregate, they put data together, 4 items, and add them. Because they didn't have enough data. Now have much more data, much better data set. So it's just a small improvement. I like the work for extremely important for poor countries and so forth. That's make the main message. But you have to do a little better than that for to advance science. So that's about it. Now about the judiciary. You're completely right. There is some paper. First of all, I think there was a judiciary changing. It's improving a little bit. I tend to still have lots of problems in the Senate, but I think we benefit from that though. And also they accept the law. In many countries they don't accept the law, and here they accept the law. Start in Rio, no, the very case that might have lots of problems, but they accept. And in São Paulo, I was teaching lots of judges before the law, in several, about the new law, and then they didn't know anything, but they accepted in a basic term. Don't talk too much with lawyer, but then they say, oh, if you look at each case, they'll be totally upset. But overall, I think is but there's a very interesting study somebody did in the chapter in the Bankruptcy Reform in Brazil, a Spanish guy that did very well in the job market in the U.S. Not Spanish, Italian, is working now in the LSE, London School of Economics. What? No, sorry. I forgot somebody. I thought once I was speaking about that, and the guy said the name of the guy, but I thought it was somebody was saying. I forgot his name, but anyhow. And he said that the new law in Brazil, had a different effect according to some measure of efficiency of judiciary. So where in some states where judiciary are more efficient, they did better. It's very interesting work with this guy. And then so I got some measure of the efficiency of judiciary. So again, they are correct. I mean, Schreines and Schleif and Gales, the role of judiciary, I think, is very important. And I think they improve a little bit in Brazil. They accept the law. Also because the law, that's why you should design a law that you know in advance the judiciary is more willing to accept. Because you just had liquidate fund, forget about it. That I think we're smart enough to design a law that to be some room for saving funds, you see? Because that way you, I think that part is, we have to take in consideration already what the behavior of the judiciary is going to be.
Hi, Professor. Thank you very much for your speech. My name is Kyle. I'm a master's student here in the school. And my research is on the too big to fail legal framework. And I'm actually pretty much interested in the bankruptcy framework that has been developed in the past few years. And recently, I presented a paper here in the school. It was actually a preliminary research, a working paper, where I tried to rescue the development of the bankruptcy framework for financial institutions here in Brazil. And my personal curiosity was whether to establish not correlations, which is a very technical word, but to find out what was the influence of international standards and international consensus on bankruptcy law and bankruptcy for financial institutions on the Brazilian framework. And until 2008, until the recent crisis, I could not find that Brazilian framework for failure of financial institutions was influenced by international standards, because there were actually no agreement and consensus on what is the best design for financial institution bankruptcy for a given country. And in the past few years, we've seen this amount of documents issued by the FSB, by the Basel Committee, on how to design an efficient resolution system for our country. And my question is whether it is desirable that we adopt these recommendations, these standards, considering that we have an institutional history learning that we created some instruments and mechanisms, mainly throughout the 90s, where we had the financial crisis after the monetary stabilization, that actually gave powers to the central bank to proceed to make resolution proceedings that might be sufficient or interesting for our reality. My question, for instance, just to illustrate my point, is whether this conversion of debt into equity, the bail-in, is desirable considering that we raise the cost of capital for financial firms. And we have statistics from the IMF that saying that Brazil financial crisis in the 90s was actually one of the lowest in terms of cost to GDP comparing to other countries. So, I mean, aren't we imposing costs to the system by adopting these standards, especially the bail-in, that we could actually solve these problems by designing our own institutions? For instance, one thing that the central bank is doing right now, we've been seeing in the past few years, is using the depository institution as an instrument, as a mechanism. So this is just a general question on whether the consensus on these new reforms is okay and we should now adopt like the central bank is doing, because they had a law, a model law, and they just excluded in 2009 the law on the resolution, and now we're making another one. Are we going to have to update this law again in 3-4 years because the international consensus will update again?
Yeah, and I agree with you. That's very difficult. I already said that before. To have a consensus, what should the new legislation be? But let me tell. The fact that we didn't have big problems, for example, the crisis in the 90s didn't lead to a big cost in terms of fiscal costs. No? Should not be an indicator, because these things ex ante and ex post, I mean, they're very different. No? Perhaps you have a bigger crisis, it might cost more fiscally. And also, as a consequence of that, because in the beginning people thought it had cost a lot in fiscal terms, they introduced a law in Brazil that's saying that you could not use public funds anymore to rescue banks. So, in order to say that you're going to be able to use public money to rescue bank, you have to be more tough on creditors. So, I agree with you that should not, for a second observation that you did, should not follow every single piece of new ideas that appear abroad, because we have our own institution. But I think we're very small. You have to learn a lot from them. You cannot just look at the past. We're so well, because I see so many people saying that, oh, system is so good. We're passing this crisis so well. Watch out, because we passed it so well because the financial market was not that developed. For example, I showed you the banking loans increased normally because of bankruptcy law. And then I hope increase more. I hope you become more financial, have more financial deepening, because there's an optimal amount of financial development. I think you were underdeveloped in terms of finance. So we'll be more like the rest of the world and be more subject to this crisis like that. And for example, the deposit insurance that you mentioned appeared in the US in the 30s, just adopted in the 90s. 60 years lag. You cannot wait until we need, and then we start having a new idea, adopt a new idea appear abroad. You should look at these new ideas. I believe the increase of cost of capital is an important issue. Should not exaggerate in the hand, but you should be talking with the new ideas abroad and then adopting it.
Hi, Professor. Thanks. That was a fascinating talk. I'm Morgan Ricks from Vanderbilt. I worked in the U.S. Treasury on Dodd-Frank before it was adopted, and worked on OLA in particular. So I was very interested in your comments on that. And we were very optimistic about it at the time. I think one thing that we've noticed in the past year or so from the FDIC is that they've decided to take an approach which they call single point of entry, meaning that they want to simply take the parent company of a diversified financial firm into the resolution proceeding, but leave the subsidiaries, the actual operating entities, as going concerns. And the reason that they decided to go in this direction, although they don't say it directly, is that they don't think that the system can tolerate a default in the money market. and therefore they need funding to keep the operating entities going because they're funded largely in the money market, and the only source of funding that will work for that is the Fed. There's no private lender who could possibly honor the runnable liabilities of Citi or J.P. Morgan. And so the reason I give that background is that the direction in which policy has moved in the past kind of 18 months in the U.S. Has deviated from where we thought OLA was going originally, and into something that looks quite different. So my question is whether your sense is really to get your reaction to whether in outside of the U.S. context, it's realistic to expect that a large financial firm can be resolved without the funding of the central bank standing behind certain liabilities of the firm. That's the conclusion that the regulators have effectively reached in the U.S., but I was interested in what your reaction is to that.
Say your last point.
I think in the U.S. the conclusion has been that that resolution of a large financial firm does not work without funding provided by the central bank, and that it's not going to work otherwise. Now that wasn't the original design of OLA, but that's where they've effectively moved with this single point of entry. And so you didn't speak much about the funding of the resolution in your talk, but I'm just interested in your reaction to that direction of policy and whether you think a large financial firm in Brazil or in another Latin American country could be resolved without systemic consequences in the absence of the central bank funding the resolution.
Okay, very good comments. First of all, it's true that I didn't mention this single point of entry. My friends in the U.S. been talking, even in this meeting in the central bank 3 weeks ago. Some people there talking a lot about this very important new development after OLA. And I think that it looks very good idea. That's simple, and that's your first comment that I think is a very come after OLA. I don't know if how to put that in the legislation exactly and so forth. I think the U.S. doesn't have a legislation for that. I think they can interpret perhaps OLA in this way, from what I understand, right? You don't need to change OLA because they think there will be a mess. Take forever, never going to do it. So, but I think the courts could interpret and have a single point of entry. Yes. And I think Brazil should go into the same direction. Also, it's a very good point. There's new ideas that's showing up in the abroad that I tend to like them. And then the second point is without the use of public money. I think it's not credible. People just be too much afraid of systemic risk. And you see the economy dropping and financial systems crashing. Even there is a liberal view, no, economic liberal, that say that, should markets self-regulate and then Finnish bank, let them go do whatever they want. It's not credible because nobody is going to believe that's going to be. So we have to work in advance, knowing that we're going to use public money, but we're going to put some cost on it. That's why I like bailing in, new ideas. I don't know exactly the magic formula for it, but I think put the cost on it, because the public said, come on, you can do it, leave your bank, I guess it's still rich, and then public is not going to tolerate that either. But to use public money temporarily, at the end, most cases, the use of public is not that big. At some point, the credit looks extremely big, but then at the end, in most, even international cases, not only in Brazil, it doesn't look that big. But then that's not correct, because at that point, it looks big. It looks costly for the public. So you cannot only look exposed, because it gives you an option value for. So we should put all this cost on the persons, on the owner of the bank or the creditors of the bank, and then. But then at the end, I think the use of some public money. You mentioned use the FGC in Brazil, like FDIC in the US. Money is a good form that appear in in the 30s. Now in the US, and most countries repeat. But again, you cannot use that for everything. I don't think that's going to do it. Forget it, because if you're going to save all the credit of banks, it's going to be enormous free riding, and then it'll be a completely crazy system, because nobody's going to watch the situation of the bank. So you have to put limits on that. So what was put the burden on the credit of the bank and the owner of the bank, but then eventually temporarily use the public money, and then you're never going to know where that's going to end.